Welcome back, students and scholars. Today we are closing our ASC 205 series with final revision, IFRS Bridge and SAP Bridge. This is not a new heavy lecture. Think of it as the final classroom board where we step back and see the whole picture clearly. ASC 205 has taken us through comparability, discontinued operations, liquidation basis, and going concern. Now we will log the full memory structure and then briefly connect the US GAAP view with IFRS and statutory accounting. So let us make this final video sharp, practical, and easy to revise. If we had to capture the whole ASC in one sentence, it would be this: presentation changes when the business story changes. If periods need comparison, ASC 205-10 helps. If a major business exit occurs, ASC 205-20 helps. If liquidation becomes imminent, ASC 205-30 changes the reporting basis. If survival doubt exists, ASC 205-40 drives the evaluation and disclosure. That is why ASC 205 is not decoration, it is presentation with judgment. It helps users understand what kind of story the financial statements are really telling. Here is our final learning path. First, we will revise the master map. Then we will quickly revisit each subtopic: ASC 205-10, 205-20, 205-30 and 205-40. After that, we will use a diagnostic test to decide which subtopic applies in a case. Then we will review common mistakes because those mistakes are exactly where exams and real reporting situations become tricky. Finally, we will bridge ASC 205 with IFRS and SAP, not as a full comparison course but as a practical connection. Let us start with the master map. ASC 205-10 asks, are periods comparable? ASC 205-20 asks, is a major business exit separate from continuing operations? ASC 205-30 asks, is liquidation basis required because liquidation is imminent? ASC 205-40 asks, is going concern doubt present and what should be disclosed? 4 subtopics, 4 presentation questions. Whenever a case looks confusing, do not start by memorizing random rules. Start by asking, what is the presentation problem here? ASC 205-10 is about comparability. Comparative statements help users see patterns, changes, and trends that one period alone cannot reveal. Consistency supports comparability, but when presentation changes, the change must be explained. Reclassification may be needed so prior periods remain readable beside current results. And remember the big distinction: reclassification is not automatically restatement. Reclassification changes where amounts appear. Restatement changes what amounts were reported. The memory line stays simple. Comparability is the bridge between periods. ASC 205-20 is about discontinued operations. A disposal must pass the 3 gates: component, disposed or held for sale, and strategic shift with major effect. Selling something is not enough. A routine asset sale is not discontinued operations. A small product exit is not automatically discontinued operations. The disposal must represent a major business exit that changes the financial statement story. Once it qualifies, discontinued operations are presented separately, and users can separate continuing performance from the results of what has exited. ASC 205-30 is about liquidation basis, and the trigger is everything. Liquidation basis does not begin because the company is struggling, losing money, or breaching covenants. Those facts may raise going concern questions, but they do not automatically change the reporting basis. Liquidation basis applies when liquidation is imminent. Then assets are measured based on expected realization, liabilities and liquidation related costs are recognized, and the entity prepares liquidation basis statements. The memory line is one of the strongest in ASC 205. Distress is not liquidation. ASC 205-40 is about going concern judgment. The sequence matters. Step 1 identifies whether substantial doubt exists using known and reasonably knowable information. Management plans do not enter Step 1. If substantial doubt is raised, Step 2 evaluates whether management's plans are probable to be implemented and probable to mitigate the doubt. Then disclosure follows the conclusion. If no substantial doubt is raised, no specific going concern disclosure is required. If doubt is raised but alleviated, disclosure is still needed. If doubt remains, stronger going concern disclosure is required. Now let us use the ASC 205 diagnostic test. Ask the right question first. Is the issue about period comparison? Then think ASC 205-10. Is it about a major business exit? Think ASC 205-20 and run the 3 gates. Is it about liquidation becoming imminent? Think ASC 205-30. Is it about the ability to meet obligations and continue as a going concern? Think ASC 205-40. This diagnostic approach stops you from mixing standards. One question at a time, one framework at a time. That is how professional judgment stays clean. Let us review the common mistakes. First, calling every disposal discontinued operations. No, all 3 gates must be cleared. Second, using liquidation basis too early. Financial distress is serious, but liquidation basis requires liquidation to be imminent. Third, using management plans in step 1 of going concern. That is a sequencing error. Fourth, ignoring comparative presentation when prior periods need to be represented. Fifth, overloading comparison points without diagnosing the issue. Most ASC 205 mistakes come from rushing to a label instead of identifying the correct subtopic. Now let us build the IFRS bridge. The big picture is this. US GAAP and IFRS often share similar reporting objectives, but the mechanics can differ. Both frameworks care about clear presentation. Both separate discontinued operations from continuing operations. Both care about going concern disclosures. But US GAAP is often more prescriptive in certain ASC 205 areas, especially liquidation basis and the structured going concern sequence. So do not think of the IFRS bridge as same or different only. Think of it as similar purpose, different rule architecture. For discontinued operations, the broad idea is familiar under both US GAAP and IFRS. Qualifying discontinued results are separated from continuing operations and comparative periods are represented so users can compare properly. The differences are more about mechanics and disclosure form. US GAAP under ASC 205-20 has specific presentation and disclosure requirements, including certain continuing involvement disclosures. IFRS 5 also separates discontinued operations, but it is less prescriptive on some of those detailed disclosure mechanics. For students, the safe memory is the architecture is similar, the details differ. Liquidation basis and going concern create a sharper IFRS bridge. US GAAP has ASC 205-30, a specific liquidation basis accounting model when liquidation is imminent, including dedicated liquidation basis statements. IFRS does not have the same general liquidation basis model. Ongoing concern, US GAAP uses the ASC 205-402 step sequence. Identify substantial doubt, then test management plans. IFRS, mainly through IAS 1, also requires going concern assessment and disclosure of material uncertainties, but the explicit US GAAP style sequencing is less codified. Same concern, different mechanics. Now let us shift to SAP, meaning statutory accounting principles, not software configuration. This is a different reporting lens. US GAAP focuses on decision-useful reporting for investors, creditors, and other financial statement users. SAP is built around regulators, solvency, and policyholder protection, especially for insurance entities. The question becomes, can this insurer meet policyholder obligations? Because of that purpose, SAP often uses a more conservative reporting posture. The memory line is useful. SAP sees presentation through solvency. The SAP going concern note has a familiar structure. The entity evaluates conditions and events that may raise substantial doubt. Unimplemented plans are not used too early to dismiss the problem. Management then assesses whether committed plans can alleviate the doubt. Disclosure covers the conditions, management's evaluation, and the plans considered. That feels similar to ASC 205-40, and that is helpful for learning. but the environment is different. SAP operates within state regulatory oversight, and the main audience is the regulator protecting policyholders, not the capital market investor. Let us now log the final ASC 205 memory card. Compare present periods side by side, keep policies consistent, and explain reclassifications. Discontinue. Separate only major strategic exits, not every sale. Liquidate. Shift the basis only when liquidation is imminent, not merely because the company is struggling. Doubt. Identify the problem first, evaluate plans second, and disclose based on the conclusion. Presentation is not decoration, it is judgment. If that sentence stays with you, the whole ASC 205 series has done its job. Finally, ASC 205 gives us the presentation mindset for the next connected topics. ASC 210 continues the balance sheet structure. ASC 220 connects with income statement and other comprehensive income presentation. ASC 230 takes us into cash flows. ASC 235 brings us into notes and accounting policy disclosures. So ASC 205 is not an isolated island. It is the opening discipline for reading financial statements like a professional. If this ASC 205 series helped you, please like the video, share it with your colleagues, and subscribe to Commerce Regiment. You have done an excellent work by completing this series. In the next standard, we keep building the financial statement presentation map with the same clarity and discipline.